Today's the day, Singapore. Centurion Accommodation REIT, SGX's very first purpose-built living accommodation REIT, is officially listing at 2 p.m. today, 25th of September 2025. If you've been hunting for stable, cash flow-generating REITs with juicy yields, this one might just make your watch list. But here's the million-dollar question. Should you jump in these few days, or wait for the dust to settle before buying? This video was requested by many of you in the Wealth for You community, so thank you for voting and sharing your thoughts. We're going to break it all down. Portfolio, yield, valuation, oversubscription, risks, and whether this REIT deserves a place in your dividend portfolio. So stay with me till the very end. And smash that like button so more Singaporeans can watch this. And subscribe to Wealth for You for more SGX dividend investing tips. Just a quick disclaimer. This video is for education and entertainment only, not financial advice. Always do your own due diligence before investing. Chapter 1. What is a REIT? Let's start with a quick refresher. What exactly is a REIT? A REIT, or Real Estate Investment Trust, is basically a company that owns income-producing properties. Think offices, malls, warehouses, or in this case, worker dorms and student housing. Instead of you buying an entire building yourself, you simply buy units of the REIT on SGX, just like buying shares. The REIT collects rent from tenants, pays all the expenses, and by law has to pay out at least 90% of its profits back to unit holders as dividends. That's why REITs are so popular with Singaporeans. You get a steady stream of rental income without ever having to be a landlord or chase tenants for rent. Chapter 2. What is Centurion Accommodation REIT? Alright, now let's talk about the star of the show. Centurion Accommodation REIT, or CAREIT for short. This is a brand new REIT spun out of Centurion Corporation, which you might know as Singapore's largest operator of purpose-built worker accommodation, listed on SGX under the ticker OU8. They've taken some of their crown jewel assets and packaged them into a REIT so investors like you and me can get a slice of the action. At the point of listing, CAREIT owns a pretty interesting portfolio. It's made up of 5 worker dormitories right here in Singapore, plus 8 student accommodation properties in the UK and 1 more in Australia. And it doesn't stop there. Once they complete the acquisition of Macquarie Park in Sydney, the portfolio will grow to 15 properties with more than 27,600 beds in total. Here's the best part. These properties are almost fully occupied. Worker dorms are running at about 97% occupancy, while the student housing portfolio is sitting close to 96% occupancy. That's about as close to full as it gets, which means the rental income stream is already very stable from day one. And clearly, investors are taking notice. The IPO was a massive hit, 16.6 times oversubscribed overall. And the Singapore public tranche, the portion that everyday investors applied for, was an eye-popping 30.9 times oversubscribed. That kind of demand sends a clear message. Institutional and retail investors see CAREIT as a rare opportunity to invest in a unique, income-generating asset class that doesn't really have a direct competitor on SGX. Chapter 3. Yield and Financials. Now let's talk about what income investors really care about: the yield. CAREIT is projecting a very healthy 7.47% distribution yield for 2026, and that number is expected to climb to about 8.11% in 2027 once the Mandai expansion beds are up and running and the Macquarie Park student housing asset is fully stabilized. That's pretty attractive compared to many of the big office or retail REITs in Singapore, which are often yielding in the 5 to 6% range right now. On top of that, CAREIT's balance sheet is in great shape. Its gearing, basically how much debt it has compared to the value of its properties, is just 20.9% at IPO, which is very conservative. Even after they take on extra debt to fund the Macquarie Park acquisition, gearing only rises to around 30.1%, still comfortably below MAS's 50% cap for REITs. What this means for investors is simple. There's plenty of headroom for the REIT to take on more debt in the future to buy more properties, and that could help grow the income stream further without taking on excessive financial risk. Chapter 4. Cheap or expensive? All right, let's dig into the numbers and see how the market is valuing CAREIT. At the IPO price of 88 cents per unit, and with about 1.72 billion units issued, CAREIT's market capitalization comes in at roughly $1.5 billion, making it a sizable mid-cap REIT right out of the gate. If we look at the price-to-book ratio, which compares the unit price to the net asset value, CAREIT trades at around 1.05 times book value. That means investors are paying about a 5% premium over its NAV per unit of roughly 84 cents, a signal that the market is willing to pay up a little for this portfolio's quality and stability. Now, REITs are usually valued by yield, but it's still helpful to glance at the price-to-earnings ratio. Based on projected 2026 distributable income, CAREIT is trading at around 13 to 14 times earnings. A reasonable multiple for a REIT with such high occupancy and visible growth. The return on equity is also healthy, projected at 7 to 8%, which lines up nicely with the forward yield. It tells us that unit holders' capital is being put to productive use to generate income. And here's an important piece of the puzzle: the leverage ratio, or gearing. CAREIT's gearing is just 20.9% at IPO, which is very conservative and gives the REIT plenty of debt headroom to fund future acquisitions. Well, it's trading slightly above book value, which means you are paying a small premium. But for that premium, you're getting a projected 7.5% yield that grows above 8%, plus a very strong balance sheet and a visible growth pipeline. Compared to many retail and office REITs still trading below NAV today, this isn't a bargain bin buy. But because this is a unique niche asset class with near full occupancy and stable long-term demand, the premium seems well justified. Think of it as buying a prime location rental property where the tenant is rock solid and signed for years. Sometimes it's worth paying a little more for peace of mind and predictable income. Chapter 5. Growth Pipeline. One thing I really like about CAREIT is that it's not just a buy it and hope for the best kind of REIT. There's already a very clear growth pipeline mapped out, and honestly, that's quite rare for a brand new listing. First up, we have the Mandai expansion. This project will add around 3,696 new beds by January 2026, which means more rental income coming in without having to buy new land. That's a very cost-effective way to grow. Next, there's the Macquarie Park student housing asset in Sydney. The REIT has already lined up a fully debt-funded acquisition, which means no dilution for unit holders, and the property comes with a master lease in place until the end of 2027. That's basically like signing a guaranteed rental contract, which helps to stabilize income during the ramp-up period. And finally, don't forget the sponsor pipeline. Centurion Corporation still owns other purpose-built worker and student accommodation assets, and CAREIT has the right of first refusal to acquire those in the future. So as long as the deals are accretive, there's room for more growth down the road. All of this together gives investors a clear line of sight for rising distributions over the next 2 years, something you don't often get with a newly listed REIT. Chapter 6. Key Risks. Of course, no investment is without its risks, and CAREIT is no exception. One big factor to watch is foreign worker policy risk. Since a large part of CAREIT's income comes from purpose-built worker accommodation, any tightening of Singapore's foreign worker quotas or changes in government policy could reduce demand for beds, and that would have a direct impact on rental income. Then there's currency risk. Remember, a good chunk of the portfolio's income comes from the UK and Australia. If the British pound or Australian dollar weakens against the Singapore dollar, The distributions you receive could be slightly lower, even if the properties themselves are performing well. Finally, there's execution risk. The Mandai expansion is a big part of CAREIT's near-term growth story, and if there are construction delays or cost overruns, the boost to DPU we're expecting in 2027 could take longer to materialize. That said, the good news is that CAREIT is starting off with low gearing, high occupancy, and stable rental contracts, which puts it in a strong position to weather these risks and deliver on its projections. Chapter 7. Who should consider buying? So, who might CAREIT be a good fit for? If you're an income-focused investor looking to boost your passive cash flow, CAREIT's 7.5 to 8% projected yield could be very appealing. It's backed by a portfolio that's almost fully occupied, with a visible growth pipeline from the Mandai expansion and Macquarie Park coming online soon. Plus, the fact that the sponsor is holding nearly half the units means their interests are very much aligned with unit holders. That's a nice confidence booster. But here's the thing. Just because the IPO was massively oversubscribed doesn't mean you should FOMO in right away. IPO day can be volatile, and there's always a chance of short-term profit-taking from those who got an allocation. If you're a long-term income investor, you might prefer to wait a few days and see where the price settles before starting to build your position. Focus on getting a good yield on cost rather than chasing the opening day excitement. Personally, I see CAREIT as a satellite REIT, a nice yield booster to complement core holdings like Mapletree or CapitaLand REITs, but probably not the anchor of your portfolio. Final thoughts. So here's the bottom line. Centurion Accommodation REIT is offering something quite special on SGX. You're getting exposure to two resilient sectors in one shot: Singapore's purpose-built worker accommodation and global student housing, backed by near-full occupancy, a visible growth pipeline with Mandai and Macquarie Park, and a very healthy forward yield of 7.5% climbing to over 8%. Add to that a low gearing ratio and a sponsor that's holding almost half the units. And you've got a REIT that looks well-positioned to deliver stable, growing distributions. But of course, there are risks to keep in mind, from foreign worker policy changes to currency fluctuations in the UK and Australia, and potential project delays. So don't just FOMO in because of the oversubscription hype. Think about whether this fits your own portfolio strategy, and focus on your yield on cost over the long run. And remember, the goal isn't just to look rich on paper. It's to be cash flow rich, with reliable dividends hitting your bank account month after month. That's what gives you real freedom and peace of mind. What do you think? Are you planning to buy on day one, or will you wait for a pullback? I'd love to hear your thoughts in the comments below. Let's get a discussion going. If you found this video useful, hit that like button so more Singaporeans can see this, subscribe to Wealth for You, and don't forget to tap the notification bell so you never miss our next dividend investing breakdown. Let's keep building that cash flow rich portfolio together.